Right, now we're going to talk about monetary and fiscal policy. So first we'll talk a bit about monetary policy. When you see the Federal Reserve, I want you to think monetary policy. They control the money supply. And if you remember that video that showed the Federal Reserve taking the gold bricks into their reserve building, and of course the money that's printed at the Treasury and at the Mint, the Bureau of Engraving and Printing, actually gets monetized and enters the economy through the Federal Reserve. So they control the amount of money that's floating around in the economy. Couple questions. Who's the head of the Federal Reserve and what are the goals of the Federal Reserve? So see if you can answer those, and then we'll take a look at what you put. The current head of the Federal Reserve is called the chair, and that is Janet Yellen. And the Federal Reserve has three goals. Price stability, that means keeping inflation not too low, not too high, full employment, and economic growth. But as you remember, this deals with the number inflation, this deals with the number unemployment, and this of course is GDP. If GDP is up, unemployment will be down, but inflation will be up. So they've got goals that are kind of contradictory. It's very, very difficult to meet all of these goals at one time. How many districts does the Federal Reserve have? Hopefully you remember. There are 12 districts, and we're really proud of that because one of them, District 6, is our district where Atlanta is the head. So very nearby, you can take tours of the Federal Reserve in Atlanta if you so desire. Which part of the Federal Reserve buys and sells securities or bonds? Federal Open Market Committee, that's correct. And that consists of the New York district chair and a rotating number of district chairs along with the Federal Reserve chair who always sits as the head of that committee. But even if the Federal Reserve chair votes for something, he or she may not get it because there are, of course, 6 other votes on the committee. What is monetary policy? Monetary policy is the control of the money supply set by a central bank. So other countries have central banks and enact monetary policy. The 3 tools of monetary policy. In our country, there are 3 things that our Federal Reserve can do. See if you can list those things to a partner. They can buy and sell securities. We've often called those bonds or treasury bonds in class. They can set the discount rate, and they can set the reserve ratio. The discount rate is the rate banks can borrow from the Federal Reserve. So if banks don't have enough in reserve at the end of the day, they can borrow from the Fed at what's called the discount window. All this is done online, although it used to be a literal window that you would go to. And this is the rate that those banks would receive. The reserve ratio is the amount that banks have to keep on hand in cash reserves. So they can loan out a good deal of the money that comes in, but they have to keep some on hand to sort of ensure the stability of the bank. And typically, historically, it's been about 10% for many years now. So the Federal Reserve is going to look at the business cycle and decide what it should do during different times in the business cycle. What it should do during the business cycle. So if we're in a situation of growth, the business cycle is expanding, GDP is headed up, you know, inflation will also be headed up, and unemployment will be headed down. Well, if we're growing too fast, remember we make that example of the car going too fast. If you think about The Wolf of Wall Street, if you've seen that movie, I would not recommend it for the R rating, but you know, the economy was clearly moving too fast at that point, and the Fed wants to put the brakes on that. So during growth or inflationary periods, so when you've got high inflation, the Fed is going to try to slow it down. So they're going to have contractionary policy or tight money policy. And when the Fed does that, they are going to do 3 different things with bonds and securities. So I want you to take a look at your sheet, and I want you to fill it in for what you think the Fed would do with bonds or securities, the discount rate, and the reserve ratio. You should have said that the Fed will sell bonds. When the Fed sells bonds, that means they're putting bonds out in the economy and money's coming back to the Fed. Raise the discount rate and raise the reserve ratio. If you raise the discount rate, it becomes more expensive for banks to get loans, so they're less likely to do so. And if you raise the reserve ratio, then the Fed has said that banks have to hold more and more goods on hand, and that means banks can't loan out as much money. So all three of these actions will contract the money supply. Typically, the Fed doesn't take all three. Usually they start with buying or selling bonds, but the other two are actions they could take. Typically, they do one at a time. So the Federal Reserve during contraction, when the business cycle is in contraction, GDP is headed down, inflation is slowing down, and unemployment is headed up, the Federal Reserve wants to improve the economy. So think about an economy with low blood pressure. The kind of medication you're going to get is going to be medication to raise the blood pressure of the economy. So the Fed's going to use expansionary policy. And I want you to fill in what the Fed should do to pump more money into the economy to turn this contraction around. What they want to do is turn this car around and head back into a period of expansion and recovery. So fill that in. And you should have said that they are going to buy bonds. If the Fed buys bonds, they're taking bonds from you and giving you cash. So there's more cash out in the economy. They're going to lower the discount rate. If the Fed does that, loans are cheaper. And now you're like, hey, I'll go get that new car. I'll go get that new house. Why? Because banks are okay with running into needing loans from the Fed, which means they can afford to lower their interest rates. And finally, they could lower the reserve ratio, which means banks don't have to keep as much money on hand. They have more money to loan out, and the increase in supply of money to loan out means that they'll lower the price of those loans. Now let's talk about fiscal policy. When you see the word fiscal, I want you to think about taxing and spending. I want you to think about the president and Congress. This is the type of policy that you and I are more familiar with, and it's the things that you've talked about in your government classes and in U.S. history in the past. So fiscal policy is government taxing and spending. Who sets fiscal policy? The president and Congress. So Congress will pass the budget. The president can either veto or approve that budget, and of course he typically suggests that budget to Congress in the first place. What are the two parts of fiscal policy? Taxing and spending. You've seen that already. How can fiscal policy be used during growth and inflationary periods? So, fiscal policy during growth, the business cycle is going to be headed up, GDP is going to be headed up, inflation will be headed up, and unemployment will be headed down. So during growth, what we may want to do if we've got really bad inflation is slow this growth down. To slow the growth down, we want less money in the economy. So fill in these two blanks. You should have said raise taxes. That's going to take money out of people's pockets. And lower spending. Now, there's a situation here known as an automatic stabilizer that could have this happen anyway. If things are going well, you're going to move up into a higher tax bracket, so your taxes will be raised automatically, and fewer people will need welfare or unemployment benefits, so spending would lower automatically. So in some case, this happens already, but this is not very popular to do during times of growth. So that's why we really depend on monetary policy and the Federal Reserve sometimes to slow things down when it's politically unpopular, because the Fed is completely independent. Once the chair and the members of the board of directors of the Fed have been appointed, they can serve for 14 years. If you're a board of directors, they can serve for 4 years if you're the chair, and they don't have to worry about what the president does. They're not going to lose their job. Here, if congressmen decide to raise taxes and lower spending, they're very likely to lose the next election. How can fiscal policy be used during contractionary periods? Well, when the economy is in contraction, things are bad, and you are pretty familiar with that because we have been dealing with the recession of 2008 and the recovery since you have been really paying attention. So GDP is headed down, inflation is headed down, and unemployment is headed up. This is not a good economy. And the big argument, there's a theorist called Keynes who said it's very important for us to act, particularly the fiscal part of the government, the President, Congress, to act during this time period. So fill in those blanks for what you think the government should do if the economy is in contraction. Hopefully you said that the government should lower taxes and raise spending. And this is exactly what happened. At the tail end of Bush's administration, he lowered taxes a good deal, but he also started a great deal of spending to help kick the economy into gear. And President Obama took over and really focused on the increase in spending side to get our economy out of recession. Our economists argue about how well this works. That's up to you, but it certainly follows the Keynesian theory that we need to do a lot of spending and pump a lot of money into the economy to make things better. So during contraction, we want things to expand. Think again, if you have low blood pressure or low blood sugar, you want to raise that. So you're going to do the opposite. So these types of policies, fiscal and monetary, are counter-cyclical. Hope this helps.